right, welcome to another episode of Fintech Intellects In-Depth Interviews. My name is Dan Carmody, and I'm the Executive Director of TreaSolution. And I'm really pleased to be joined today with Joel Telpner, who is a Senior Partner with Sullivan Worcester, which is a law firm based out of Boston, but I believe Joel works out of New York. So welcome, Joel. Thanks for joining me today.
Thank you, but I thought you were supposed to be talking to Fintech Intellects, and so I'm not sure I should be actually participating in this, but I'll do my best.
Well, I would beg to differ. You are in charge of the Fintech and Blockchain Practice at the firm. So, so you qualify. So I'm thrilled to have you on the line today and to talk with you. So Joel, tell me a little bit about Sullivan Worcester and specifically what you do for the Fintech and Blockchain Practice at your firm.
Okay. So we are a global law firm, a mid-sized law firm that started in Boston. We have offices besides Boston in New York, in Washington, in London, and Tel Aviv. And I run the Fintech and Practice group for the firm. And it is a corporate practice where the focus of the clients that we work with are primarily folks that are doing things in the Fintech and blockchain space. And so a lot of what I do day in and day out involves a lot of startups or early stage companies that are looking at blockchain technologies and looking how they can reinvent or change the world or do things differently using blockchain. And a lot of the activity or focus in blockchain happens to involve financial services. And so there's a strong kind of correlation between financial technology or fintech and blockchain. But the common denominator, again, is looking at new technologies and how we can disrupt the way people do business right now using blockchain or related types of technologies.
That's great. So would you say that your clients are primarily financial institutions, startups, VCs, a combination of all?
All of the above. I mean, some of the clients are just early stage companies that are trying to come up with new technology products where blockchain may be playing some type of role. Some of the clients are private equity or venture capital firms that are looking at investing in the space or are looking at using what are called digitized tokens to actually go out into the market with their own fund interests, but in a new form. Some of the clients are what I would call intermediary service providers, people that are trying to create things like trading platforms or exchanges for the blockchain space. And then we have some government clients. And so it's really diverse because you've got a lot of different players looking at how they can use blockchain for all kinds of different reasons. And so that makes it both fun and challenging because every day tends to be different from every other day.
So you and I started talking a few months back. You submitted a presentation to be a speaker at the upcoming US Fintech Symposium and for everyone that's new to Fintech Intellects, TreaSolution it produces the US Fintech Symposium, and I'll put a link down below in the description for people who are interested in viewing that website. But you and I started talking about speaking at the event, and you were going to talk about Central Bank Digital Currencies, which is a really hot topic now. Can you tell us a little bit more about what they are, what their use cases are, and things along those lines?
Fundamentally, what a lot of governments are looking at is, can we take our currency that was created in paper in coinage form when that was cutting edge technology and now take advantage of where the world is now and create it in a completely virtual form? And why is this happening now? Well, a couple things. One, this is how blockchain technology ties into it, because blockchain technology allows us to create a way to manage, store, and verify data in a verifiable, immutable fashion that creates this system that we didn't have before. And so if we're going to have money that exists in only digital form, we need to be able to figure out how we move it from one person to another, how we track who owns it, how we figure out who's entitled to that money. And blockchain technology creates this really interesting and over time efficient way to do all of that. And so as a result, central banks and governments are starting to look at, can we take advantage of new blockchain technology and issue our currency in a digital form? And so that means a couple of things, because right now governments and central banks are looking at different ways that we could do this. And so without getting way too far into the weeds, let's talk just a little bit about a couple of different ways that this type of digital currency could exist. One way is that all of us could have direct accounts with a central bank. So in the United States, that could mean that instead of us having an account at Citibank or JP Morgan, we'd all have an account directly at the Fed. And our account at the Fed would hold our dollars in digital form, and we'd be able to make, in effect, deposits and withdrawals. And we would transfer, for example, that virtual currency from our account at the Fed into our smartphone or into our smart card, and then we'd go out and spend the money just like we always do now by just walking into a store, walking into a Starbucks and saying, "Here's my virtual money. Here's my phone." Again, not completely dissimilar to the way Apple Pay, for example, works, but we would be linking directly to the central bank. Another way that we could potentially do this is for a central bank to create a digital currency, but still require us to access that digital currency through commercial banks the way we do now. So we would still have deposits, in accounts and checking accounts in commercial banks, but that in turn would be backed by the commercial bank having corresponding deposit in the central bank, so that indirectly we still have the virtual currency from the central bank, but we're doing it through the commercial bank acting as an intermediary. Which way that goes will depend in part on a number of factors, including the extent to which we want to continue to be able to empower commercial banks to perform activities like lending activities and so on that require these deposit accounts as a means to provide the capital for commercial banks to do the things that they do. There's a third structure in which a central bank actually creates a representative value of the fiat currency. So instead of it being a direct issuance, it's an indirect one where the central bank, for example, the Fed, takes a bucket of dollars, puts the dollars into an account, and then issues a digital coin, a digital currency that is backed one-to-one by that bucket of dollars. And so what you've got now in this case is in effect an obligation, in effect a debt instrument of a central government that is backed by the underlying currency. And so again, right now we're looking at different ways to create central bank digital currencies. The other thing that governments and central banks are looking at is whether it gets rolled out only at a so-called wholesale level or at a retail level, because initially it may be just with the technological complexities of creating central bank digital currency, that creating one that initially is used as at a wholesale level, like an interbank payment mechanism, may be step one before we finally roll it out to the retail or individual level. Because to get into the hands of individuals like you and me, we have to be able to not only create this digital currency that we can track on a blockchain, but we have to be able to integrate it with things like smartphones and smart cards, create systems that, addresses what happens if you lose your phone or if you lose your smart card. We have to have people be able to use it and access it without having a certain level of technical expertise. We can't, say to people, oh, by the way, you can have your money in digital form, but you have to learn how to create a private key, and you have to learn how to store it, and you have to learn cryptography. If we can't expect people to adopt digital currency if we can't make it, in effect, something to use as simple as turning on your smartphone. And so we've got a long ways to go, but that's what governments are looking at now. They're experimenting, and the pandemic has really accelerated that process for all kinds of reasons that I think are fascinating to look at and talk about.
Yeah, I was reading recently that people are estimating that digital adoption of financial services has been accelerated by about 5 years, primarily because of the pandemic.
But by the way, currency itself is a terrible carrier of bacteria and germs. And so if you can access money without having to leave your home or without having to go into public areas where social distancing becomes a concern, that's an important factor. Other factors are things like if we look at as part of the CARES Act, a lot of people in the United States got their $1,200 checks. And there were a number of cases where the checks didn't make it to the right person. The checks got lost. The checks got stolen. The checks were issued to people that were dead or weren't entitled to it. And all of those problems could have been addressed so much better if we were using a digital means of taking a central bank digital currency and directly giving it to individuals that were able to prove through blockchain technology who they were and that they were actually entitled to that payment. And so we could have made that process so much more efficient. And then there's a third factor, and this probably is less driven by the pandemic, but is an important, really important driver, especially when we go beyond advanced countries like the United States in the EU, and we start to look at emerging market and developing countries. For those countries, access to banking, things that we take for granted, is really hard. You may have situations where people live in locations that don't even have a bank within proximity to where they live. So they literally would have to go hundreds of miles if they just want to be able to go into a bank and utilize bank services. And then on top of that, in a lot of emerging or developing market countries, banks are not interested in servicing a lot of poorer individuals within those markets. And so the access to banks and banking services are often limited to the wealthy within that country. And so when you look at those two factors together and you go into the emerging market or developing market part of the world, there are a lot of people that just don't have access to banks and therefore don't have access to financial services and to the global economy. And we're sidelining, millions and millions of people, that could be part of the global economic structure. And so using digital currency over time allows us to, in effect, democratize access to money and to finance, and to really empower people and to improve the global economic circumstances for everybody. So on a long-term basis, it could completely change the economic profile of a lot of emerging market or developing countries, or at least the citizens of those countries. And that's really cool.
So it sounds like there's a lot of potential benefits with something like this, but with every benefit, there are always challenges and downsides. Are there any downsides to looking at a structure like this? Are there any challenges, internet access across the globe, things of that nature?
So let's talk about, I want to talk about challenges first, then we'll come back and talk about downside. But the challenges are, yes, we're talking about technology. And so this can only work if people have access to the internet, have access to smartphones, are in a place where there's Wi-Fi. And if you can't bring the technology to people, then this does no good. And so that's why I say when you roll it out at the retail level, part of it is an old-fashioned hardware play as well, where you've got to make sure people have access to laptops or to smartphones and to Wi-Fi. And while, again, we're getting there, it's going to take a long time. And but by the way, the best example as to how you do that is if you look at some of the countries in Africa that didn't have the traditional landline telecommunication systems that we're used to, they were able to leapfrog that issue by immediately going into cell phone technology. Mm-hmm. And so as we see those types
are you referring to Kenya with M-Pesa?
Yeah, exactly.
Yeah.
So they were able to, rolling out a cell phone network as compared to creating wiring an entire country with landlines is cheaper and faster. And so they were able to do that. And once you start to do things like that, you can bring the technology down to the level of individuals in those locations that make it possible then to give them access to a digital currency. But again, it's going to take a while. It's not going to happen overnight, but it's promising. But I also want to talk about, one of the downsides or negatives, because money, if we look at traditional money, paper money, it's dumb. What I mean is that it doesn't do anything other than you can spend it. So it because it is inert and it's just a physical piece, physical paper. If we don't want to track it, we don't have to, and so that creates problems. When we're talking about central bank digital currency or similar types of things, we're talking about ultimately computer code that exists on a blockchain, which sometimes we call smart contracts. And the most important element of that is that because it's computer code, we can build things into it. In other words, we can build into the virtual currency or the digital currency not only the ability to kind of look at where the transactions are going and what's being spent where and how, but we can tie an identity into it so that you can verify it's your money and not somebody else's. So you could walk in, you could walk into a grocery store and using central bank digital currency that's tied into your smartphone and tied into an identity, just walk up to the clerk and hold up the phone to pay, and it would automatically, among other things, verify to the clerk, for example, that you're over 21 and you're entitled to buy beer. And so we can embed now, once we convert money from being dumb money to smart money, we can convert into it the ability to do other things like track and manage identity, which makes it easier to transact, makes it easier to protect yourself from losing your money. But it also means that if it's used the wrong way, it makes it easier for governments to kind of monitor what you're doing. How are you spending your money? Where are you spending your money? Who are you giving your money to? Are you buying things that you should be buying, or are you buying things that maybe you shouldn't be buying? And so there is concern when countries like China, which are moving forward aggressively to create a central bank digital currency, are potentially looking at how they can embed within that central bank digital currency the ability to monitor transactions, monitor activities of their citizens. Because if you monitor how people spend their money, that's one of the most significant ways you can monitor what people in your country are doing day in and day out. And so the downside is that governments could use a central bank digital currency as a way to monitor their citizens in a way that most of us, at least I know, I wouldn't like. So that's the potential negative. If there is no controls imposed upon a government, if a government forces you to transact in digital currency, they get rid of all of their paper and coins, and then they start to monitor what you're doing, that's a bad thing.
So do you think cash will go away?
Someday it probably will. I think we're a ways off, but cash doesn't make sense. Cash is an old concept and we don't need it. It's costly to print. It's costly to protect. It creates a relatively easy means for people engaging in money laundering or other illegal activities. And, as we've seen in the pandemic, it also has some, health-related concerns as well. So the notion of having cash just makes no sense. And it's really a question of, the transition period. And the way to think about it is, for those of us that are old enough, I mean, not me, of course, but you, if you go back and look at the evolution of internet, in the mid-90s, when it took 10 minutes to wait for a page to download with your dial-up modem, and where virtually nobody had laptops because laptops were either too heavy to carry around or too expensive, people weren't thinking about that we could have a virtual universe the way we do now and conduct meetings over Zoom as we do. Nobody was thinking that because they were saying, no, the internet's way too clunky, way too slow, way too expensive, way too inefficient. That's never going to happen. And so we're kind of at that stage with blockchain technology. It's still pretty early in the world of blockchain. And so we've got a long ways to go to develop the technology to get to the point where we can truly replace cash. But the technological developments with respect to where blockchain is going are happening at a much more rapid pace than how the internet evolved. Everything is just much quicker now as far as how fast the technology moves forward. So we're going to get there.
So you're saying that blockchain now is like the internet at 5600 baud modem.
Yeah, because right now for most blockchain, the different types of blockchains that use different types of technology to achieve the way they manage in data, in distribution data. But most blockchains suffer from similar problems, which is that the amount of data that can be added to the blockchain at a given time is fairly small. And if you're looking at financial transactions and you can only process a few hundred transactions in a second, given, for example, Visa that can process 50,000 transactions per second, you've got to really be able to up your game in order to be able to create a robust system that's going to be used for payments among individuals and companies. The second problem is that right now, blockchain technology requires a lot of energy to operate. The process of blockchain technology, which is taking what's called a distributed ledger, a way of storing data on a distributed basis, is combined with a cryptology mechanism that creates the way that we protect that data and make sure that it can't be hacked or modified or tampered with. And so the process of the cryptology process right now that most blockchains use requires a huge amount of computer power and therefore energy in order to create the cryptography mechanism that allows us to continually add data to a blockchain. So we've got to solve the energy problem, we've got to solve the amount of data that can be stored on the block, and we've got to solve the speed at which transactions can be processed in order for us to really make blockchain a feasible solution and for central banks to be able to utilize it to issue and track their digital currency. So again, we're probably in the blockchain world where we were in the internet world back in the mid-90s, where the internet would be too slow to do the types of things that we do with it now. But if we fast forward 25 years, I mean the things that we can do using internet technology, people just thought would have been crazy back in the mid-90s. So blockchain will get there too.
Sure. So let's sort of go back into the past now. So you studied undergrad at the University of Iowa in Iowa City.
Right.
You went on to get a law degree from the same university, if I'm not mistaken.
That's right.
Handful of years later, MBA from Wharton.
Right.
Can you tell us a little bit about your career path? How did it migrate, if you will, from Iowa City to New York City and everywhere in between?
Well, so either I'm really good at reinventing myself, or I just can't hold a job. But I'm from Iowa, which is why I went to both undergrad and law school in Iowa City. I mean, it's a great school, but I mean that was the reason I was there. And when I wanted to go to law school, I really wanted to come to some East Coast law schools, but I was paying for it myself. And the difference between paying for in-state tuition at University of Iowa College of Law and paying for a private school on the East Coast was way beyond my means. But I decided that, notwithstanding the fact that I went to school in Iowa, I really wanted to come to the East Coast and work. And I figured, well, in the worst case scenario, I can work in New York for a couple of years. If I don't like it, I'll move back to somewhere in the Midwest. But once I got to New York, I kind of forgot to leave. So there weren't many, as you can imagine, there weren't many law firms from New York that actually came all the way out to Iowa and interview, but there were a few. And I was fortunate enough to get one of those New York firms to actually take a chance and hire me. So I came to New York. And, part of the motivation for me is I wanted to do international law, whatever that means or whatever it was. And so I ultimately was at a firm called Sherman and Sterling. And one of the reasons I went to Sherman was because they had this network of offices around the world. And I thought, well, maybe if I get lucky enough, I can work overseas. And so two things I want to mention about that. One is that when I interviewed at Sherman, the first thing that the partner that I met with asked me was, so why should we hire an unknown quantity from an unknown law school? So Iowa wasn't actually the most prevalent law school of choice for New York law firms, but again, somehow I got hired. And once I was at Sherman, I really started lobbying to go overseas. And I kept trying to tell the powers that be that I wanted to go to London. And so one day, the head of the M&A group came up to me and said, we need a senior level associate who has both finance and M&A practice in Paris. Would you like to go to Paris? And I said, well, sure, but I don't speak French. And he said, you'll learn. And so they sent me to Paris.
Minor technicality.
Yeah. I got there and realized after my first week there, when the heel of my shoe broke, I had no idea how to walk into a shoe store and say, hey, I need a new heel. So I had to point. But I learned over time enough French to survive, spent a couple of years there. And then when I came back from Paris, I left Sherman Sterling to become the U.S. General Counsel of a global French investment bank that was building out all of their U.S. operations. And they were looking for somebody that had this connection to France and could, work, they felt, with both Americans and French, interact with the home office in Paris. And so I had all the right qualifications after having spent a couple of years in Paris. And for me, it was an opportunity to jump into a general counsel role at a fairly young age without having to go through a number of intermediate steps. So I left Sherman, became the general counsel of what was called Caisse de Dépôt at the time. Now it's Natixis, and helped them launch a lot of their capital markets and structured finance businesses. A lot of what they were doing involved all kinds of really complex structured finance and derivatives transactions. And as I grew the legal department, and as the type of transactions continued to get more complex, I started to think about the need to better understand some of the business side of what I was doing. And so I approached the bank and said, hey, I'd like to go back and get an MBA and an executive MBA program, and I'm going to need to take a lot of time off to do it. And by the way, it's really expensive. Would you pay for it? And somehow they agreed to do it. And so while I was working full time in this general counsel job, I was going back and forth to Philadelphia from New York to do the Wharton MBA program, which was, between a full-time GC job, and that was partly the hardest 2 years of my life, but also the most rewarding. This was in the late 90s. This was also during the time where we were having a real tech boom. This was before the dot-com bubble boom. And I took a venture capital class at Wharton, and it was taught by a VC partner. And he said, anybody that's interested in getting involved in venture capital, come see me. And I thought it was fascinating, so I went and talked to him. He said, so what do you do? And I said, I'm a lawyer. And he said, oh, you'll never be a venture capitalist. So, and well, I said a few expletives, but
what was his? Were you ever able to find out what his motivation?
Just lawyers can't be good business people. You can never understand what you need to do as a business person to be. VCs have to be creative and think on their feet. All of those things. A lot of corporations, including my bank, were looking at potentially getting started in the VC space because, again, it was very hot. And so captive venture capital firms were one of the things that were of interest. And they asked me to kind of look into it. And so I started looking around at who else had created were creating or had created a captive venture capital firms. And I came across Koch Industries. Koch brothers are infamous. Either you love them or you think they're the evil empire. But in any event, Koch Industries was looking at starting a captive venture capital arm, and they had hired one person who was a Wharton grad. And I'm thinking, oh, well, that's interesting, since I just finished my Wharton program. And I reached out and talked to him, and he put me in touch with the right people. And the position they were looking for was somebody who was going to be both a managing director on the business side, but also be responsible for the legal needs for the group. And they wanted somebody that both had a JD and MBA, and I'm clicking that box. They wanted somebody that had both in-house and law firm experience. I'm clicking that box. They wanted somebody that had spent time doing finance and corporate work. I was checking that box. And here was the clincher. So after, in addition to the fact that the first hire was a Wharton grad, there was a dotted line back to Koch Ventures, the parent company, with respect to liaising on the legal side. And the person that I would have to liaise with on the legal side was the University of Iowa College of Law grad. So at this point, I said, well, clearly this is my job. They actually wrote the job description for me. I interviewed with them, and 6 months after having completed the Wharton program, I was a managing director in a venture capital firm. Left New York. We launched in Scottsdale, Arizona, of all places. And there was a logic to that madness in that, again, the tech market was very hot at that point, and we didn't think it would make sense to go directly into like Silicon Valley and try to compete with the big boys like Kleiner Perkins. And so we looked at a map, and we geographically drew a semicircle and that covered San Diego, Los Angeles, Salt Lake City, Denver, Dallas, Houston, and looked at that semicircle because we looked at all of those markets that we felt were being underserved by Silicon Valley. But had a lot of interesting things happening, and Phoenix or Scottsdale was one of the the points that was right there at the base of that semicircle. And so we set up there, and we were fairly technology agnostic, but we tried not to primarily focus on that geographic area. Although we did have in some investments outside of that, that was our primary focus. So I spent a couple of years having the most fun I've ever had as a managing director, helping to find businesses for us to invest in, making the investment decisions, sitting on boards of startups. And it was great, but then we had 9/11, the dot-com bubble burst, and for a number of reasons, Koch Industries decided to pull the plug on Koch Ventures and shut it down. They actually asked me to stay on for a while to help unwind everything, so I did, but eventually, we were going through a recession after 9/11, and I'm sitting in Scottsdale saying, now what do I do? So I came back to New York and decided to go back into private practice in a law firm. And I went back to the folks at CDC where I had, been the general counsel, and, I was nice enough to pay them back for spending all that money on my education by leaving them. But I came back to them and said, hey, I'm thinking about coming back to New York. I want to come back to a law firm as a partner. The only way that I'm going to get into a law firm is if I can guarantee them a book of business. And I said to the CDC, would you guys be willing to give me business if I came back? And they surprisingly said yes. I said, do you think you'd be willing to guarantee like at least 7 figures of business my first year? And they said yes. So I was able to come back to New York, join a law firm, because I had CDC saying that they would give me at least $1 million worth of business my first year. And so came back into private practice, was primarily doing structured finance and derivatives because that's what I was doing before I had gone to Arizona. And so kind of moved right back into that space. And so that takes me up now to 2014. In 2014, I was at Jones Day, a huge law firm, 2,400 people all over the world, and doing primarily structured finance and derivatives. And a colleague of mine, a litigator, got a call from the company Overstock. And Overstock, he knew a consultant working for them, and the consultant said to him, hey, Overstock wants to issue a security on a blockchain. We're using another law firm. We're not happy with them. Can you guys do it? And the litigator said to his friend, dude, I don't even know what the hell you're talking about. Because again, this was early 2014. So he called me and he said, hey, Joel, can we do this? And I said, let me get back to you tomorrow. And I kid you not, I went home and I'm sitting at home that night and Googling, what is blockchain? Because at least now the internet's fast. We've got Google. So in 2014, I'm trying to, figure out everything I need to know about blockchain. So I go back the next day and I said to the litigator, well, I'm not sure. If the Overstock people want to talk to us, let's at least meet with them. What have we got to lose? So the executive team flew in from Salt Lake City, and I don't know, they hired us. So I spent most of the next 2 years of my life working on this project because nobody had ever done something like issuing an equity security on a blockchain. And we spent hours and hours and hours working with the SEC and FINRA, just trying to explain what it is we were trying to do, and trying to figure out how issuing and trading the security on the blockchain would work within our existing regulatory framework, that govern security transactions. And so it was really complicated. Nobody had ever done this before. There were really no laws. There was no precedent. And so it took 2 years until everything got approved by the regulators, and we went to market in the fall of 2016. And by this time, I'd spent all of this time on this really cool stuff, blockchain technology, and where a lot of what I was doing wasn't really traditional legal work because there were no laws, there were no regulations, there were no precedents. So this is kind of like going back to what I was doing on the VC side, and it was so cool. It was so much fun. It was so fascinating. And so when that deal went to market, I left Jones Day and came to Sullivan. And by comparison, Sullivan's we've got, I don't know, maybe 220 lawyers. So we're a tiny speck compared to Jones Day. But the difference is at Sullivan, I can work with a lot of smaller early stage tech companies, with startup companies, with players that are trying to do stuff in this space. And so it was a great opportunity for me to come and launch Sullivan's Fintech and Blockchain Practice, get to work, in this cool area, and go down that rabbit hole wherever it takes me. But the one great thing about it is that no 2 days are alike now. I'm always I've always got people knocking on my door, smart, younger people, typically younger than me, that are really smart, have these great ideas, are looking at how this technology is going to reinvent the world. and I get to help them do that. And that's, that's just a great thing.
Yeah, it sounds like it's an interesting story. You're making a lot of moves, both physically and within your career, right? Making a lot of moves. I'm wondering, for the people that are listening, can you distill down maybe one or two bits of advice that have worked well for you throughout your career that you might be willing to share?
Yeah, I think two things, but I mean, one is just personality. If I look at lawyers, there's a lot of lawyers that like certainty, and they like, they're in their narrow field, and that's what they do. They do that really well. So if you don't like uncertainty and you don't like change, probably what I'm going to say is not that helpful. But the most important thing is to look at the world not from a straight line, but sideways sometimes, to be able to look around corners and know that whatever you're doing now is probably not what you're going to be doing 5 years from now. None of what I'm doing now existed when I was in law school. The concept of derivative transactions, all the things that I was doing, didn't exist. The structured finance that I was doing didn't exist. The tech things I was doing in the VC firm, utilizing early tech, internet technology, didn't exist. Blockchain didn't exist. So if you plan a career based upon only doing what you know now, unless you're happy, never ever changing, it doesn't work. So you've got to accept the notion that most of what you're going to do throughout your career are going to be things that you could never have contemplated. You didn't know were going to be there, didn't happen, weren't happening at the time. And so look for what excites you, look for what makes you happy, and constantly willing to kind of look around that corner and say, hey, wait a minute, that's interesting. Maybe I should look more at that. And if you happen to have a personality where you're comfortable with taking some risk and living with some level of uncertainty, then combine the two together and always see where that next adventure is going to take you.
Yeah, I just by our conversation here, that's sort of some of the themes that I was able to extract from your stories is comfort with pursuing innovation and ambiguity.
And by the way, I mean, I will be the first to admit that there are also financial risks. If perhaps if I had stayed at a law firm and been a partner and never done these other things, I would I would have made more money throughout my career, because when you start over, and for example, you go to a venture capital firm and then the firm shuts down and then you have to start over again, that involves financial setbacks as well. So you have to be willing and comfortable to recognize that a nonlinear path may be nonlinear as far as the financial remuneration, but over time, when you stick to it, I still think it all pays off in the end.
Yeah, and I'm a big fan of defining your own success, and that doesn't necessarily always correlate to the amount of money that you make.
I totally agree with that.
Yeah.
I mean, obviously, everybody needs to be comfortable, but success is about passion and what makes you happy. It's not only money.
That's great. So thanks for sharing that. I know that you brought a very interesting backstory to the table, so wanted to explore that a bit. So
again, the perfect example of somebody who can't hold down a job.
it sounds like an example of someone who's diving into really interesting things. So at least from my 2 cents. But let's sort of bring it back to the present. You ended at Sullivan and Worcester, and what you're doing now, you speak with fintech and blockchain entrepreneurs all the time, it sounds like.
Right.
So I'd love to hear your opinions as to what you think is really interesting in the fintech space now. And sure. Is there anything, like you were mentioning, around the corner that you have an eye on that you think might be innovative and worth discussion?
So in any in technology cycle, you've always got hype, boom, bust, and then what comes up after the crash. And we've seen that in blockchain. We saw the so-called ICO boom and bust, all these people doing what were called initial coin offerings, issuing different types of cryptocurrencies, a lot of which were nonsense, some of which were fraudulent, some of which were just poorly thought out projects and ideas. But what's emerged from that are a lot more interesting and serious endeavors that utilize blockchain technology to see how we can move things forward. So on the fintech side, as we talked about, central bank digital currencies is a great example. Doing other things to create payment systems and finance systems that maybe bypass banks to the extent that regulations permit that are things that people are working on quite extensively in order to, again, bring financial inclusion, especially to people in emerging developing markets that don't have access to traditional banking. So it's not just central bank digital currency projects, but it's also people looking at, can we create other types of payment systems or access to financial services that bypass banks? So if banks aren't going to serve those people, can we do it without, going around the banking system? So we see a lot of that happening.
I mean, it's like you said, it just seems like the future has a ton of opportunities available to it when you look at blockchain and the exponential growth of this technology over the next few years. So, well, Joel, thank you for your time. I very much appreciate you participating in this long form interview. I really enjoy these because we're able to dive into the details and take tangents, which is always interesting. Really appreciate your thoughts, your opinions, your wisdom over the years of sharing it with us. And thanks so much for joining us.
My pleasure. Look forward to seeing you in person one of these days.
Likewise, at the next US Fintech Symposium.
Yes, exactly.
All right, Joel. Thanks so much. Take care.
Take care.